Look at any professional athlete. They don't just walk into a gym, load the bar with random weights, and hope to get stronger. They track their reps, adjust their workouts, and measure their progress over time. To survive in trading, you have to adopt that exact same structured regimen. In this video, we are going to build your performance review loop. It's a 5-step sequence that takes your raw trading data and converts it into the exact mathematical proof of your long-term profitability. Before we start, get your materials ready. Open a blank spreadsheet or grab a notebook and pull up the records of your last 5 trades. Implementing this framework separates the people who rely on guesswork from the people operating a verifiable mechanical system. Step 1 is building your daily trade journal. Think of this as your master ledger, the foundational data source that feeds the rest of your review loop. This spreadsheet shows the hard data you need to log for every single trade. At a minimum, you need columns for your entry price, exit price, stop loss, profit target, and the final financial result. But the numbers only tell half the story. If we look at the far right of the sheet, we see the critical subjective columns. You need a space to log your emotions and a discipline score. Did you feel fear? Were you overly confident? Did you exit late? Many traders skip this part because it feels tedious. But if you don't write down your emotional state, you make it impossible to spot patterns of self-sabotage, like consistently hesitating on valid setups or revenge trading after a loss. An undocumented psychological mistake acts as an invisible leak in your strategy. Until you write it down and track it, you are guaranteed to repeat it. Step 2 is the weekly review. At the end of every trading week, you need to time block a specific analytical session to zoom out and look at your behavior. This graphic breaks down how to structure that time. The first 10 minutes are purely for decluttering your workspace and doing a mind dump to get lingering tasks out of your head. The next 20 to 30 minutes are for reviewing your recent actions. You compare your initial plan to what actually happened in the market and update your priorities for the coming week. There is a stringent rule for this weekly session: completely ignore your dollar amounts. Your only goal here is to answer one question: did you execute your predetermined rules? Once a month, we move to step 3, the monthly metrics review. This is where you put on your accountant hat and look objectively at the financial results. This dashboard shows the exact numbers you need to audit. You are looking for your win rate percentage, your average profit, your average loss, your risk-reward ratio, and your total net profit and loss. When you aggregate 30 days of data into a single graph like this, a string of individual losses loses its sting. You start seeing the short-term dips as normal variance within a long-term upward trend. By separating your weekly behavioral check from your monthly financial audit, you stop acting like an emotional gambler and start running your trading like a rational business owner. All of that data collection leads to step 4, calculating expectancy. This is the ultimate test of your system, the number that proves exactly how much money your strategy makes per trade on average. This image shows the mathematical formula behind every profitable trader. Expectancy equals the probability of a win multiplied by the average win, minus the probability of a loss multiplied by the average loss. Let's break those variables down. You take your win rate and multiply it by the dollar amount you make on an average winning trade. Then subtract your loss rate multiplied by your average losing trade. Let's plug in some baseline numbers. If your win rate is 50%, your average win is $100 and your average loss is $50, you multiply 0.5 by 100 and subtract 0.5 by 50. Your expectancy is a positive $25 per trade. This is exactly how a casino operates. The house doesn't win every hand of blackjack, but because the rules dictate a positive mathematical expectancy in their favor, they are guaranteed to profit over thousands of hands. You do not need a 90% win rate to be successful. As long as your expectancy calculates out to a positive number, you have a mathematical edge that will survive the long term. Step 5 is strategy refinement. Once you know your expectancy, you use your journal data to dictate your adjustments. If your expectancy is negative, you look at your metrics to find out why. Maybe you need to tighten your stop-loss placement, reduce the amount of risk you take per trade, or completely cut out a specific setup that consistently loses money. A major mistake beginners make is throwing out an entire strategy just because the current expectancy is slightly negative. Strategy refinement is like maintaining a complex machine. You don't throw the whole engine in the trash when it sputters. You identify the weak parts, make small, deliberate tweaks, and slowly tune it until everything runs smoothly. This graphic maps out the entire process. Notice that these steps do not form a linear checklist with a finish line. They form a continuous, unbreakable cycle of execution, review, and optimization. Beginners obsess over winning their very next trade. Professionals focus entirely on feeding high-quality data into this loop to improve their overall system. It's time to start your loop. Take the records of the 5 past trades you gathered earlier. Enter them into a new spreadsheet right now and calculate your baseline win rate. When you execute this review process consistently, week after week, month after month, you build a system that naturally self-corrects, and you will never have to rely on luck to make a profit again.